Hello and welcome to Anu's classroom. In this video, we'll be talking about comparative, common size and trend statements. So by the end of this video, I hope that you'll be able to understand what comparative statement analysis is, what common size analysis is, and what trend analysis is. We'll also be talking about interfirm or cross-sectional analysis, Dupont analysis, using financial ratios to predict bankruptcy, and application of financial ratios, as well as a few drawbacks of financial ratios. So in the last video, we talked about financial ratios and ratio analysis. So what's next after that? In order to understand the financial statements of a firm and hence comment on the financial performance, we have to compare the ratios over time as well as compare them with other similar companies. So a comparative statement analysis is a common approach to study the changes in the financial performance of a firm by simply comparing the financial statements for at least 2 years of the same firm, okay, and calculate the changes between the 2 years. That's why it's called a comparative statement analysis. Another way of analyzing the financial statements is by preparing a common size statement. In this, each item of the balance sheet will be expressed as a percentage of the total assets or total liabilities. And in this analysis, the financial statements will be redrafted to be expressed in terms of this common base. That is, the total assets or total liabilities. Total assets or liabilities in the case of balance sheets, whereas net sales in the case of income statements. Therefore, such statements are called common size statement analysis. Coming to trend analysis, another important technique of analyzing the financial statement is to examine them over a period of time, say for over 5 years, or study the trend over the years, especially in terms of income statements like sales, profits, or items of balance sheet like net worth, debt, etc. Now, talking about interfirm or cross-sectional analysis is that besides investigating the financial statements of the company in question, analysts will also have to compare the financial performance of the firm with its close competitors or the industry averages. Such an analysis is referred to as the interfirm analysis or the cross-sectional analysis, which will enable the analysts to compare the firm's performance with its competitors or industry average. This financial ratio is compared with the firms that are similar in terms of sales, asset size, market share, etc., in order to examine the financial performance. So that makes the inter-firm analysis. So you're comparing the financial statements of your firm with a comparable other firm. Dupont analysis is a framework for analyzing the fundamental performance of a company, and it was created by Dupont. It is used to decompose the different drivers of the return on equity ROE ratio, which is calculated or which we know of as profit after taxes divided by equity. So this return of equity is decomposed into net profit margin, asset turnover, and equity multiplier, and it will allow investors to focus on the key metrics of financial performance individually and identify the strengths and weaknesses of the company. Now, how we can use the financial ratios to predict bankruptcy is through a score called Altman Score. Edward Altman investigated the cases of business failures in US using a multiple discriminant analysis or MDA technique, wherein he categorized firms into those that are likely to fail and those that are not likely to fail. And based on his study, Altman developed the following formula, which combines 5 financial ratios, which he found as most significant, and he assigned weights to each of these ratios to arrive at one composite score which he called as the Z-score. So more on Altman's Z-score we will talk about in a separate video, so that you will have enough time, we'll have enough time to dig deeper into that and understand it much better. Okay, so a few of the applications of financial ratios include assessing the performance of firms, credit analysis, forecasting of bankruptcy like in the case of Altman's Z-score, as well as valuing the firms. Some of the drawbacks of financial ratios are that financial ratios are calculated based on the financial statements. So what happens is that they summarize the financial transactions of the firm as they had occurred in the past. So these financial ratios are heavily dependent on these particular statements and they are backward looking. So at the most, what you can do with financial ratios is do a post-mortem of sorts of past events. Okay. So in the past, this is what happened. Apart from that, we can't make any idea of how it's going to be there in the future. Maybe we can have an assumption that, okay, for the past 5 years, this is the trend that we are seeing. So hopefully it will continue in the next year as well, as the maximum or the highest, what you can say, the highest assumption or prediction that you can make, the best one. Okay, and also the no two companies are exactly similar in their asset profile. Capital structure, technology being used, markets, products, all these things will not be exactly one on one similar with any other firm. And companies also change over a period of time. So how we were operating last year may not be the way how we will be operating 5 years ahead. So as the profile of these companies changes, it will become very difficult to compare the ratios also. There is always a wide variation in the definition of certain terms also, like equity, profit, all these things, how exactly they are defined. It is also depend, okay. Cost has different meanings, like on the basis of the context we use. Similar is the case with equity or profit and all. And that also will make the comparison of the ratios very difficult, because the way I have defined profit or I have defined cost or equity may not be the same way defined it last year, or I defined it 5 years back, or maybe some other firm defines it. It will depend. It will differ. So, what exactly are we comparing when we are comparing the return on equity or the net profits? What exactly is it? We cannot be exactly sure, right? We just have two figures, uh, and we are just hoping that the definition of equity or the definition of profit is the same for us and the other firm. That's rarely the case. So those are a few drawbacks of financial ratios. I hope you got a general picture of financial ratios and how we use them, and the different analysis statements like comparative statement and trend statement and common size and all. We will look deeper into Dupont analysis and Altman score, which are two important concepts in this unit, in separate videos on their own, so that you get a better idea. So I hope to see you all again in those videos as well. Thank you so much for your attention if you have made it so far. I highly appreciate it, and I also would appreciate much if you could let me know your opinions on this video by either giving us a thumbs up or a thumbs down. If you have any doubts which are not resolved even after listening to the Dupont or Altman Z-score analysis, do leave those in the comment section. I'll try my best to clarify those. Thank you very much, and until I see you in the next video, bye bye.